Hey guys, V. Rigoni Max, high performance real estate entrepreneur. Alright, so I'm here talking to you, trying to get you to understand a few things, all about financial freedom, all about getting ahead, all about not just trading your time for money. Now, what we're going to talk about today is this concept regarding cash flow when you're dealing with real estate. So before we get into it, if you're going to like the content, then hit the like button. If you want to continue listening to what we've got to say, what I've got to say here, then then subscribe to the channel. So again, I've talked about this in the past. You can listen to these channels where people are saying, hey, don't worry about the cash flow. In a year's time, everything's great. The rent went up, right? Put a little money in the building, push the rents up. You're in there for appreciation. You're pushing the appreciation. Well, there are times when that works. But let me tell you, there's specific times during a market cycle when you're in the sweet spot of real estate. Right now, you're not looking at that sweet spot. You're just not. So when I see these guys on YouTube and Instagram and TikTok, and they're all talking about, yeah, don't worry about it. I'll make that negative payment for a year or so, and then hey, everything will be good. Well, let me tell you, these are the same guys that went and bought stuff and they put it on adjustable rate mortgages 3 years ago. How's that working out? Now, what are the pitfalls of doing that? It's easy for me to say don't do it. You want to have positive cash flow from the beginning. I get it. So what are the pitfalls of just thinking that you're just going to invest for appreciation and you're willing to accept negative cash flow from day one? Well, let me tell you what some of the pitfalls are. Right now, in this country, over the last, I'd say, 90 days, there has been a huge push on insurance. We got our insurance bills. Now, maybe it goes further than 90 days, but for us, like about 30 days ago, we got all our new insurance bills for all of our properties. And let me tell you, they went up as much as 50%. 50%. How's that looking out if you already have a negative cash flowing property? That you're sitting there, negative cash flow property, and now you got a 50% hit on your insurance. Whoa, things just got serious. Yeah, you can raise the rent, but you ain't getting to raise that rent that much. Now, what's another problem that you have? Well, when you buy a property and you're going to run it as a negative cash flow, again, because you think that appreciation is going to be the number one thing for you and or your investors. And what happens after you buy a property? Well, the next year, or 6 months, or whenever the time comes when they reevaluate the value of the property based upon the new sales price, what happens to the taxes? Well, they go up. That's right, they go up. Now, did you take that into account when you were working on your negative cash flow relative to positive appreciation? In order to get that positive appreciation, you got to be able to keep the property, and that's going to be a problem. Now, what's another thing? Well, we just got through in the county the county where we own a lot of property, they just had their quadrennial reassessment of property values. Yeah, we have had some properties where the taxes have almost doubled. That's right. Across the board, they're up like 30%. And then we've got some that have almost doubled. Oh yeah, you can fight that tax thing. Get in there, you fight it hard, try to keep those things. All right, but you're only going to win a percentage of that back. And when you're talking about, 20, 30, 50%, 100% tax increases, how's that going to work out? If the property you're talking about, the property you're dealing with, that you bought with already a negative cash flow, and now you have a situation where, insurance is up 30 to 50%, taxes are up 30 to 50%, whoa, and then God forbid, you bought it with an adjustable rate mortgage, which would be just total suicide. But people did. So now they've got an increase in the interest, and so their mortgage payment went through the roof. Their taxes have gone through the roof. Their insurance has gone through the roof. And you guys know what I'm talking about, because even if you're just a standard homeowner, you get insurance, you've seen what happened. You've got your tax bill, you saw what happened. Now multiply that over 50, 100, 200, 500,000 units. How's that working out? That's why it's so important that when you're buying property, you've got to buy it right. You have to finance it right, and then you have to manage it right. If you don't do all three together, then you've got a disaster waiting to happen for you and your investors, for whoever is involved. Because in the end, the mortgage company will get their money, or most of it, when they foreclose. The tax people will get their money, no matter what, because they'll just sell it as a tax sale. The insurance people will get their money because the mortgage company will pay it if you don't. And then they'll charge you back, and they'll go out and get the most expensive. They're not going to have at all care about, the economy of comparing policies. So this is how you can get into big trouble. But if you start with a negative cash flow, because all you can see is dollar signs, because you're listening to one of these morons, just like the morons that were telling you that they were going to cut interest rates last year. Not only did they not cut them last year, they didn't cut them at all this year. And here it is. It's already July. Most likely they won't cut them for the rest of the year. You might get one. What is a 25 basis point drop in the Fed fund rate going to do for you? It's not going to turn your property around. So be very careful of this thing where people are investing for appreciation and they're ignoring the cash flow because all they can see is the dollar signs. When you see just dollar signs, you're screwed. You just don't know it. It's like a drunk taking a drink. They think it's making him smarter, but he's screwed. He just doesn't know. So think about this. Try and make sure that when you're looking at property and you're underwriting property, if it doesn't work, it doesn't work. Your job is not to make it work. Your job is not to take a bad interest rate. Your job is not to pretend like it will work if we just put up with it for a year or two. Because if you're sitting there and it's a negative cash flow already, and then you get a giant increase in taxes, you get a giant increase in insurance, your interest rate goes up. Any of these things, or a combination of them, or all of them at once, God forbid you'll lose a tenant or rates, or look at even increases in rents. There are people out there saying they were doing their calculations, their pro formas on properties, and trying to tell investors that they're basing it upon a 5 and 10% increase in rents. That's insanity. That is freaking insane. Rents go up 2%, 3% pretty normally, but they don't go up 5, 10, 15% unless it's an unusual time in the marketplace. And we're not looking in the next 18 months for a whole lot of rent increases. You know why? Because there's so much supply coming online. This year alone, there's like 500,000 apartment units coming online. And where do you think they're coming online at? Well, they're coming online in the areas that were hot. Dallas, Austin, in the areas of Florida, Miami, Phoenix. And it's choking rent increases out. So now you don't even get the rent increase. So you're sitting there, you sold this thing to yourself and your investors as the rents were going to keep going up. And so the cash flow would get better. Instead, the rents are not going up, and the cash flow has gotten a whole lot worse, and now you're starting to choke on your deal. Don't do this to yourself. Don't do this to your investors. Don't be greedy. Being greedy is not part of financial freedom. Being smart is. And listening to people that have experience when it comes to inflation, when it comes to understanding how real estate works. It's just not me. There's other guys out there that are on top of their game. Look at Ken McElroy. He's on top of his game, but he'll also tell you that if he was just starting out now, and if he was doing what he's doing now, he would have been screwed. All the construction that he's working on right now, it's cost him a whole hell of a lot more money, a lot more interest, because these projects in which they work on where they're building and it takes 24 months, 36 months, somewhere in the middle to get them done. The whole environment around real estate has changed from the time they broke ground to now. Rents have gotten softer. All these things are happening. Interest rates have gone up on the construction loans, on the end loans. All these things, materials went through the roof because of COVID. Now you got taxes going through the roof, insurance going through the roof. You think all that shit was calculated into these deals when they're... So Ken is able to absorb his increased costs. They're able to absorb all of this. Why? Because he's so big. But he'll tell you, if this was his first deals, he might not be as happy as he is today. And there's nobody smarter than he is when it comes to real estate. So be careful about what you're doing. You got to buy it right. Buy it right just doesn't mean that you got a good price on it. It also means that you're buying it in the right economy so that your good price doesn't turn into a bad price 6 months from now. You got to finance it right. So you have to finance it with the understanding that you want to maintain stability of your payment. Adjustable rate mortgages, when the interest rates are at, when a commercial loan's at 4 and a home loan is at 2, and you're going out and getting an adjustable rate mortgage, and then you went out even and you said, well, yeah, but I'm going to take care of it because I'm going to get a cap, right? And a cap is where you pay for a cap. It's like insurance for the interest rate. And so some people have done that. I heard one where they paid $50,000 for a cap for a year. I think it was a year or 2 years. That's expired. Now they want $1 million to extend that. $1 million. So be careful. Even if you want to try to put a little protection in, understand where you're at in the cycle of real estate so that if you're going to take some additional risk, you're taking it at the right time, the right part of the cycle. Remember what I always say, real estate goes up slowly, it rolls over slowly, it goes down slowly, and it recovers slowly. So buy at the right time of the cycle. And sometimes you just got to wait. People who've waited for the last couple of years on multifamily, they're going to do really well probably in the next 12 to 18 months, 2 years. But if they were out buying last year and they weren't getting some huge discount for, I don't know, some 30% discount, they're going to be screwed. Because these areas, when you have sales have dropped on multifamily, 75% last year, 75% this year. Well, that's some serious numbers. Do you think prices can maintain themselves? Cap rates can maintain themselves when you have sales drop through the floor year after year? No. They will eventually weaken and the cap rates will go up and the prices will come down. So don't be too quick. Everybody wants a deal. But hey, don't let that deal sink you. Especially if it's your first or second, third deal. You need to be right. You can even give up a little bit of the profit. Even if you're a little late from the bottom and you don't get the absolute sweet spot, you're better off being a little late than you are being early. Because being early can put you under. If they raise the taxes on you, if they raise the insurance on you, if you all of a sudden your occupancy starts adjusting to the economy and rents stop going up. In fact, rents start to go down. These are all things that can sink you. So be very, very careful at this time and think about this stuff. But remember what I say, let's get out there, let's make it happen. But when you're making it happen, you got to buy it right, you got to finance it right, and you have to operate it right. And if you screw up at any one of those three things, and some of them, they have no recourse. In other words, you could not be operating right and then get your game together and start operating right. But if you buy it wrong and you finance it wrong, it can sink you completely. So let's get out there. Let's make it happen. And remember what I say. Think big, start now, and grow fast. And when I'm talking about real estate, I'm talking about think big. And when I mean start now, I mean get the information, get the understanding, help somebody out that's in multifamily. Learn. That's how you do right now, is you learn. I'm not telling you to go out and buy right now. I'm telling you to go out and learn right now. So that when you start and you do it at the right time and you buy it right, you finance it right, you operate it right, then you can grow fast. And then you get to be successful. And then the financial freedom comes. Talk to you soon. Let's get out there. Let's make it happen. V. Rigoni.